$9.2 billion in auto loan fraud, 1.7 million repossessions, delinquencies higher than 2008. The car market just hit a breaking point, and almost nobody's talking about it. For years, banks have been approving loans worth more than the cars themselves, while dealers quietly pushed vehicles with fake mileage, flood damage, or inflated prices onto desperate buyers. And now the system built on easy credit and risky lending is finally coming apart. You can already see the cracks forming, major dealerships collapsing overnight, buyers trapped in loans they can't escape, and lenders scrambling to cover billions in missing assets. Subprime defaults are skyrocketing. Insurance rates are through the roof, and used car values are falling faster than ever. This isn't just a few bad loans. It's the unraveling of a market Americans rely on every single day. The bubble didn't just pop, it exploded. When the world shut down in 2020, something strange happened. Car prices didn't crash, they exploded. Production lines froze, shipping delays stacked up, and millions of people suddenly wanted their own cars to avoid public transport. Dealerships ran out of inventory overnight, and within months the average price of a new car jumped to record highs. It was the perfect storm: limited supply, record demand, and an economy flooded with stimulus cash. Buyers were paying full sticker prices, sometimes even above them, just to get their hands on anything with 4 wheels and an engine. But what no one realized at the time was that this boom came with a silent cost. Banks and lenders started loosening their standards to keep the sales numbers high. Loans stretched from 5 years to 7, even 8, and interest rates climbed while people kept signing anyway. Many buyers weren't even approved for traditional financing. They were subprime, or worse, with little credit history at all. Yet the deals kept going through because everyone assumed the market would stay strong forever. Prices were rising, cars were selling, and nobody wanted to believe the bubble could burst. But that illusion wouldn't last long, because what came next would expose just how fragile it all really was. By 2023, the cracks were no longer invisible. They were splitting the market wide open. The average price of a new car had climbed past $49,000, while interest rates soared to levels the industry hadn't seen in decades. Monthly payments of $700, $800, even $1,000 became the new normal. And despite those warning signs, buyers kept signing the papers. Why? Because everyone was told that cars were investments now, that prices would never go back down. But as inflation bit harder and wages failed to keep up, people began to realize they weren't buying assets. They were drowning in debt disguised as transportation. Subprime borrowers, those with weak or no credit, were hit first. They borrowed more than ever before, often taking loans worth more than the car itself. A $20,000 car could carry a $30,000 loan with a 20% interest rate. For many, it was the only way to get to work, even if it meant living paycheck to paycheck. Generation Z became the most vulnerable group, signing long-term loans during the pandemic boom, and now facing brutal reality: cars worth less than they owe, payments they can't sustain, and lenders tightening the noose. Defaults started to rise. Repossessions followed. But what triggered the real panic wasn't just missed payments. It was the moment one of America's biggest subprime lenders collapsed under the weight of its own lies. In September 2025, everything the industry had been hiding finally came crashing down. Tricolor Holdings, a massive subprime auto lender with 65 dealerships across 6 states, filed for Chapter 7 bankruptcy. Overnight, thousands of employees lost their jobs, dealerships were locked, and customers were left wondering who even owned their cars. But the real bombshell came when investigators opened Tricolor's books. What they found was fraud on a scale no one had ever seen in the auto market. More than 29,000 loans had been pledged to multiple banks at the same time. That means the same cars were being used as collateral in different loans, essentially creating money out of thin air. Roughly 40% of Tricolor's 70,000 active loans were double counted. Nearly 30,000 vehicles worth over $1 billion went missing entirely. Major banks like Fifth Third, JP Morgan and Barclays were all caught in the fallout, facing hundreds of millions in losses. And this wasn't just sloppy accounting. It was deliberate deception to keep the company afloat while defaults were soaring. Tricolor specialized in deep subprime borrowers, 68% of their customers had no credit score, and over half didn't even have driver's licenses. When people stopped paying, the company didn't slow down. It doubled down on fraud to survive. But once the truth came out, the damage couldn't be contained. The collapse of Tricolor was a signal. The entire subprime market was starting to implode. After Tricolor's collapse, analysts tried to calm the public by calling it an isolated incident. But the numbers told a very different story. Subprime delinquencies hit 6.56% in early 2025, the highest ever recorded, even higher than during the 2008 financial crisis. By mid-year, the rate barely improved, sitting at 6.31%, while prime borrowers, those with good credit, had delinquency rates near 0.34%. The market had split in two. If your credit was strong, you were fine. If it wasn't, you were sinking fast. By the end of 2024, 1.73 million vehicles had been repossessed, matching the worst years of the Great Recession. Another 2.3 million borrowers defaulted entirely, walking away from loans they could no longer afford. In states like Mississippi and Louisiana, nearly 1 in 10 subprime borrowers was behind on payments. These weren't just statistics. They were families losing the only way they could get to work, parents unable to take their kids to school, delivery drivers watching their livelihoods get towed away. And yet, as the crisis deepened, some banks decided to push even riskier loans to keep profits flowing. What they did next would shock everyone and make the situation even worse. Just when it seemed like banks would tighten up and learn from the chaos, they did the exact opposite. In September 2025, Wells Fargo quietly launched a pilot program, allowing borrowers with FICO scores as low as 540 to get car loans worth up to 150% of the vehicle's value. Let that sink in. People with almost no credit could borrow 1.5 times what their car was worth. Even those with scores under 500 were offered 110% loan-to-value financing. In plain English, a $20,000 car could come with a $30,000 loan. Wells Fargo called it a new lending solution. Experts called it what it really was: madness. This was the exact kind of reckless lending that fueled the 2008 housing collapse. But while some banks dove deeper into the risk, others ran for the exits. KeyBank, Citizens Bank, and even the Bank of Montreal all pulled out of auto lending entirely, calling it too unstable to touch. Fifth Third and Capital One followed, quitting floor plan lending, the type that keeps dealer inventories financed. What this created was a dangerous imbalance. Some lenders fleeing for safety while others chased short-term profits, feeding loans to borrowers almost guaranteed to default. The system wasn't being repaired, it was being stretched thinner than ever. And the cracks didn't just show up in the loan books, they started showing up on dealer lots. While banks were bending the rules, another kind of fraud was quietly spreading through the dealerships themselves. Across the country, hundreds of thousands of used cars were being sold with clean titles that were anything but. After a string of devastating hurricanes, over 347,000 flood-damaged vehicles hit the market in 2024 alone. Many were shipped to states with weak title laws, scrubbed of their flood branding, and resold to unsuspecting buyers. On the surface, these cars looked fine, but underneath the carpet, there were water lines, rusted wiring, and electrical systems ready to fail at any moment. For some, that great deal on a used car turned into a financial nightmare the first time it rained. And that wasn't the only scam spreading. Odometer fraud made a comeback, now easier than ever thanks to digital dashboards. With nothing more than a laptop and a $50 tool, scammers could roll back tens of thousands of miles in minutes. The National Highway Traffic Safety Administration estimates that over 2 million cars on American roads right now have falsified mileage. Some dealers were even caught resetting odometers on trade-ins, pocketing the difference while buyers paid premium prices for worn-out vehicles. Add in counterfeit parts, shady rebuilds, and disappearing warranty coverage, and the average used car buyer suddenly faced an invisible minefield. But as buyers tried to protect themselves, another wave of trouble hit, one that made simply owning a car unaffordable for millions. By 2025, even people who managed to keep their cars were getting hit from another direction: insurance. Premiums have skyrocketed more than 30% in just 3 years, following double-digit jumps in 2023 and 2024. In some states like Colorado and North Carolina, rates jumped over 25% in a single year. For many working families, that meant paying nearly $2,700 a year just to stay insured. And for owners of certain cars, insurance wasn't just expensive, it was impossible. Major carriers like State Farm, Progressive, and Allstate stopped writing new policies for millions of Kia and Hyundai models after a viral theft wave revealed that older versions lacked basic anti-theft systems. In cities like Minneapolis and St. Louis, thefts of those cars surged by over 800%, leaving owners stranded with vehicles they couldn't sell, trade, or insure. Meanwhile, the EV dream started to look more like a nightmare. Electric vehicles, once seen as the future of driving, began losing value faster than any other segment. In just 5 years, the average EV now loses 50 to 60% of its value, with luxury models like the Jaguar I-Pace and Porsche Taycan plunging over 70%. Even Tesla, the safe bet, saw massive drops after repeated price cuts demolished used car values overnight. Owners who bought in 2022 found themselves tens of thousands of dollars underwater within months. Battery technology wasn't the issue, obsolescence was. Newer models charged faster, went farther, and made last year's cars feel outdated before the payments were even halfway done. Add soaring repair costs and insurance rates for EVs that are nearly twice those of gas cars, and what was supposed to be the clean energy revolution turned into a financial black hole. And when you combine that with collapsing used car values, one brutal truth emerged. Millions of drivers were now paying luxury car prices for vehicles worth next to nothing. Across America, a new kind of driver has emerged, one who doesn't really own their car. They just owe money on it. By mid-2025, nearly 40% of finance drivers were officially underwater, meaning they owed more than their cars were worth. The average negative equity hit $6,700, and for many that gap only kept growing. Here's how it happens. Someone buys a $45,000 SUV in 2022. 2 years later, it's worth $32,000, but they still owe $41,000. They can't sell it. They can't trade it in. They're stuck making $900 monthly payments on a vehicle that's losing value faster than they can pay it off. Dealers make the problem worse by rolling old debt into new loans, creating a never-ending debt spiral. It's called negative equity stacking, and it's quietly destroying household finances. Borrowers end up paying interest on cars they don't even own anymore. Subprime customers pay an average of $915 a month, compared to $756 for those without negative equity. Nearly $200 more for the same car. Some are now on 7-year loans, meaning they'll still be paying long after the car is out of warranty, or even dead. For millions of Gen Z and millennial drivers, the car that once symbolized freedom has become an anchor, dragging them deeper into a financial hole with every payment. And if that sounds grim, the truth is even harsher. This wave of debt isn't done growing yet. But there is a way to survive it, if you know what to look for. At this point, the car market isn't just unstable, it's dangerous. But if you understand how the game is being played, you can still come out ahead. The first rule: don't rush. Prices are still falling, and experts warn the market hasn't hit bottom yet. Waiting even a few months could save you thousands. If you absolutely have to buy, go used, but be smart about it. Get a pre-purchase inspection from an independent mechanic. Run both Carfax and AutoCheck reports, and don't trust clean titles without proof. Check for flood damage yourself. Lift the carpet, look for rust under the seats, and smell for mildew. And when it comes to financing, never roll old debt into a new loan. That's how the negative equity trap starts. The second rule: protect yourself financially. Always put at least 20% down and keep your loan term to 60 months or less. Anything longer, and the car will lose value faster than you can pay it off. Avoid predatory loans from big banks offering insane 150% loan-to-value deals. Those are designed to trap you from day one. Instead, look to credit unions, which often offer interest rates 1 to 2 points lower than traditional lenders. If you already have a loan, make small extra payments toward the principal each month. Even $50 can knock years off your term. And finally, don't be afraid to walk away. If a deal feels off, or the numbers don't make sense, it's because they probably don't. The next few years will be filled with sales, repossessed inventory, and falling prices. And those who wait will be the ones in control. Because while most people panic when the market crashes, the smart ones prepare to strike when the dust settles. The numbers don't lie. The US car market isn't correcting, it's collapsing. What started as a pandemic boom turned into a debt trap fueled by reckless lending, fake titles, and billions in hidden fraud. We've seen subprime delinquencies hit record highs, banks lose hundreds of millions, and millions of drivers trapped in loans they can't escape. Now, with insurance costs spiking, EVs plummeting in value, and dealers sitting on flood-damaged cars, the system that kept Americans on the road is breaking apart piece by piece. And according to the Federal Reserve, recovery won't come quickly. Most forecasts point to 2028 before the market fully stabilizes, if it stabilizes at all. But within every collapse, there's opportunity. For those with patience, cash, or good credit, the next few years could offer the best deals in a generation. For everyone else, the only way out is awareness, knowing the traps before you step into them. Because this isn't just about cars, it's about how easily financial systems repeat their worst mistakes when nobody's watching. The bubble has already popped. The question now is, will you be ready when the shockwave hits your driveway? If this video helped you understand what's really happening, hit subscribe and share it with someone who's thinking of buying a car right now. Because a single bad decision in this market could cost them thousands. Stay informed, stay alert, and most importantly, stay ahead of the crash.